I'm Grant Mundell, investment specialist at Equity Trustees with the September monthly market review. Historically, September has been a poor returning month for equity markets. However, two major events helped spur a rally over the month. The US Federal Reserve surprised markets by cutting rates by 50 basis points, or 0.5%, easing recession fears. And Chinese authorities launched larger than expected monetary and fiscal policy stimulus, the most significant since 2015 to support the weakening economy. These two measures saw most equity markets rally. European, US and Australian share markets all gained, but the standouts were the Chinese and Hong Kong markets that exploded, both rising around 17%. Australian property securities rose strongly, as did Australian small caps, while bond and credit markets also edged higher. The Australian share market outperformed the US, driven by strong gains in the miners. Companies such as Mineral Resources, Samphire and South32 all rose by more than 20% as commodities ripped higher. Much has been said about the outperformance of the Australian banks relative to the resource companies this year, but the Chinese stimulus announcements was a catalyst for investors to fund a switch from the expensive bank sector into resources. From a macro perspective, while the Federal Reserve cut rates, the RBA locally held rates steady. That, along with Chinese stimulus, saw the Aussie dollar rise 2.2% to 69.13 US cents. The US Fed is expected to continue cutting rates over the next 18 months. The RBA is likely to start following suit early next year. Whilst economic growth locally is muted, inflation is still not quite under control, according to the RBA. Investors are pricing in that the combination of reasonable but slowing economic growth and central bank rate cuts will continue to fuel equity market gains. However, key questions remain, and these include, firstly, while the Australian share market has moved higher this year, listed corporate earnings have been revised down, meaning the valuation of the Australian share market now looks expensive, trading at a 21% premium to historic levels on a price to earnings basis. It requires earnings growth to be delivered, if not surpassed, in FY25. ASX dividends are currently forecast to slightly fall in FY25, driven by lower resource company dividends, flat income from the banks, and lower payout ratios for many industrials. A combination of a rising stock market and lower dividends has seen the dividend yield on the Australian market fall to 3.5%, well below the long-term average of around 4.4%. Some are questioning whether the Chinese stimulus is enough to offset the structural headwinds that the economy faces. And lastly, geopolitical tensions continue to rise, with events in the Middle East escalating. Oil supplies could well be disrupted, leading to higher energy prices and inflation pressures. The Equity Trustees funds performed well in September. Our Australian equity funds benefited from our overweight position in miners such as Rio Tinto and South32, while underweight positions in Commonwealth Bank and Wesfarmers also assisted performance. Our quality at a reasonable price approach remains well suited to the current environment, where valuation rigour becomes increasingly important, coupled by investments in companies with sustainable earnings streams. We continue to focus on preserving and growing the capital of our unit holders over the long term, whilst looking to produce a growing income stream. I'll be back again next month with the October monthly review.